Alright, let's talk about how to prepare your financial statements from your adjusted trial balance. On page 111 in your textbook, you see Fast Forward's adjusted trial balance, and it shows you the steps that you take to prepare your financial statements. So the first thing that you do is prepare the income statement. So you use the revenue and expense accounts from the trial balance. So again, you have to know the definitions of your accounts. You have to know which ones are revenues and expenses. But here you can see that you put all your revenues at the top, you get total revenue, then you list all your expenses here, subtract the expenses from the revenue, and that's where you get net income. So all of those accounts can be taken right off your adjusted trial balance. The second step is to then prepare your statement of retained earnings. You would use retained earnings and dividends from the trial balance, and you would use the net income figure from the income statement that you've already prepared. So again, retained earnings starts at 0, so you add net income, and then you subtract your dividends, and you come out with retained earnings at the end of the period. But as you can see, you can't do this statement until you've done this one because you need the net income figure off of it. Once those two things are done, then you can go to the balance sheet. You take all of the asset accounts and list them first, then all your liabilities, and then your equity accounts. Again, you have to know which ones are which and understand what's an asset, what's a liability, and what is equity. And the retained earnings figure comes off of this statement. So you can't do this one until these two are done. But everything else here comes off of your adjusted trial balance. And then once you have all of these done, you can prepare your statement of cash flows, which we'll talk more about later, but the information you need will be on these different reports that you've just created. So, as it says here, we prepare them in a particular order. Income statement first, statement of retained earnings, and then the balance sheet. And again, it's because you need the information from the ones that you did prior to that to be able to get that information. Alright, now, the next step is, again, rather confusing. It's what's called the closing process. And this is going to be some stuff that you just have to memorize until you understand how it all fits together. But the closing process is an important step at the end of an accounting period, after all your financial statements have been completed. What it's doing is it's preparing your accounts for the next period. So in the closing process, we have to identify which accounts get closed at the end of each period, and how do we go about recording and posting those closing entries. And then after we've closed those accounts, we then prepare another post-closing trial balance, an after-closing trial balance. The purpose of the closing process is to reset all of your revenue and expense and dividend accounts to 0, because you want to chart your revenue and expenses for each period. So each of those accounts have to be zeroed at the beginning of the period so that you can start fresh on that particular period. So this is what we have to do to be able to close the accounting period. First of all, you have temporary accounts and you have permanent accounts. The temporary accounts are all the income statement accounts, the dividends account, and an account called income summary. They're considered temporary because they're opened at the beginning of a period and then closed at the end of the period. But then you have permanent accounts, and permanent accounts are never closed. They carry their balances into the next period. And generally speaking, those are all your balance sheet accounts. So your asset, liability, and equity accounts are not closed at the end of an accounting period. So in order to do closing entries, we are transferring the end of the period balances in revenue, expense, and dividend accounts to the permanent retained earnings account. So, to understand the closing process, focus on its outcomes, updating the retained earnings account balance to its proper ending balance, and getting the temporary accounts to show zero balances for the purpose of accumulating data for the next period. So, an income statement is trying to report revenues and expenses for a specific period, whereas the statement of retained earnings reports similar information including dividends. Since the revenue, expense, and dividends accounts accumulate information separately for each period, they have to start each period with the zero balance. Now, the way we close those accounts is we transfer their balances to an account called income summary. Income summary is also a temporary account. We're only using it for the closing process. And it's going to contain a credit for all of the revenues and a debit for all of the expenses. So the way that we do this process is we find all of our expense accounts, and the balances that we have are, because expenses have a normal debit balance, their balances are going to be here on the debit side. We want to transfer each of these balances to this account called income summary. So if we credit each of these expenses, because that would zero each one of these out, we're going to move the total of all of these over here to the income summary account. So you would have a credit to depreciation expense for $375 and a debit to income summary for $375. A credit to salaries expense for $1610, a debit to income summary for $1610. So if you add all of these together, you're going to get the $4,365. That's what these total. On the revenue side, you want to close the revenue accounts. This was their balance, so you debit the revenue accounts, so you would credit income summary. Once you have put all of your revenues on the credit side and all of your expenses on the debit side, the difference between the two is $3,785. But this account is also temporary. So we're going to move the balance of this account directly into retained earnings. And in order to do that, we have to debit income summary because it has a credit balance. And then we credit retained earnings for the $3,785. The only other account that gets closed into retained earnings is dividends. The dividend account had a $200 debit balance, so we're going to credit it. So we credit dividends and we debit retained earnings. So this would now be our new balance for retained earnings. Retained earnings is the only permanent account in this whole situation. Every other account is going to be zeroed out and start fresh in the next accounting period. This is your permanent account. So, again, I've just explained that, but this is showing it, again, to you how you go about doing it. So these would be your entries to make those things happen that we've already talked about up here. This would be how you would journalize it. And then you close the income summary to retained earnings, as I've already talked about. And then you close the dividends account to retained earnings. So those would be all the steps in terms of closing. Once you've done that, you can create a new trial balance called the post-closing trial balance. Now, this is showing it to you in terms of the ledger, but this is what it would look like once you're finished. A post-closing trial balance is a list of all your permanent accounts and their balances from the ledger after all your closing entries have been journalized and posted. It lists the balances for all the accounts not closed. So basically, it's only going to be your assets, liabilities, and equity. So this is what a post-closing trial balance looks like. Obviously, it's much shorter than the one that included your income and expense accounts. So it's going to have all of your assets here, and then this, remember, is your contra asset account. It deducts from your equipment account. Here's your liabilities, also including unearned revenue, and then here are your equity accounts. And again, these two have to equal. Debits have to equal credits. So what we've just gone through in this chapter, and I know it's an awful lot of information, but we've just gone through what's called the accounting cycle. It is all the steps from the very first transaction that you analyze the transaction, then you put it in a journal, then you post it to your ledger, then at the end of the period you prepare an unadjusted trial balance, make sure your debits equal your credits, then you do your adjusting entries, then you prepare an adjusted trial balance, and once you know this is correct, that your debits equal your credits, you can prepare your financial statements, and then you get yourself ready for the new accounting period by closing the temporary accounts, prepare a post-closing trial balance just to be sure that you've got your debits are still equaling your credits, and then you're ready for the new period. This idea here of reversing entries will be something that we'll talk about later in the semester. But that is the accounting cycle that you're completing in every single period. So each of these steps has to happen in the order in which you see them here in order for you to make sure that your accounting statements, your financial statements are accurate. Okay, that's the end of chapter 3. There's a lot of material in this chapter that's very important for you to understand because everything else in the rest of the semester is going to build upon what you've learned here.